When we invest, it's best to avoid making hasty mistakes, so it's useful to have a checklist of criteria which funds or stocks have to satisfy before they make it into our portfolio. So in this video, I go through my checklist of criteria which I think are important and which funds have to satisfy before they make it through into my investments. Now, this video is sponsored by Trading 212, which is a commission-free UK investment platform. So let's look at my investment checklist in a bit more detail. The most important consideration is what the fund gives you exposure to. So if you buy a stock fund, it's going to give you exposure to the ups and downs of the stock market. If you buy a bond fund, it'll give you exposure to the yield curve. So in your core portfolio, these are the asset types that you might consider: stocks, bonds, maybe commodities and real estate. But of course, there are other considerations once you've chosen an asset class. For example, what country do you want exposure to? If you have a developed market country versus an EM country, they'll have very different risk exposures. EM is much more risky. What sector composition does your fund have? For example, if you're going through a recession, you don't want exposure to cyclical sectors. If you're coming out of recession, you probably do. Another way you can look at a fund is in terms of its factor exposure. Does it contain lots of growth stocks? Those were hugely punished over the course of 2022, and value performed much better. So understanding the factor exposure is also very important. A secondary consideration for stock funds is currency. So for example, UK investors didn't suffer such large sell-offs as US investors if they bought the S&P 500, say. That's because sterling weakened over the course of last year, and that actually reduced the losses when you were buying US stocks, when you converted back into sterling. And then finally, maybe your fund is concentrated in one of the factors above, or perhaps it has a lot of single stock exposure. If that's the case, it increases the risk of the fund, because if that sector, country, stock runs into trouble, it'll drag down the whole portfolio. And if we consider bond funds, many of the factors are similar to stock funds, but you'd also have to think about two new dimensions. One of them would be the duration of the fund. How long does it keep capital locked at a fixed rate of interest? Because the longer that duration is, the more volatile and risky the fund. Also, if you buy corporate bonds in the fund, then you have to worry about their credit quality, because if there's a pickup in defaults, you could end up losing some capital as a result. So once you understand the broad exposure, dig into the details by looking at the fact sheet for the fund. So beside me here, you can see the iShares Core Global Aggregate Bond ETF, a global bond fund. And as you'd expect, it has a large exposure to the US, almost 40%. That's a big capital market. Also to Japan, 12.6%. But look at number 3, it's China, and that makes up 9% of the fund. Perhaps that's not something that you'd want. Another example is the UK Life Strategy funds, particularly Life Strategy 100. That has a very large UK overweight. You can see it makes up 22% of the portfolio. That's despite the fact that the UK only makes up 4% of global market cap for equity. So look at these exposures, compare them with a standard benchmark. In the case of equity, you'd compare it with MSCI World or MSCI ACWI. That's the All Country World Index, which includes EM. And if there is a big deviation in terms of factor exposure, country exposure, sector exposure, remember that that tilt is a kind of risk to you. Another consideration is whether you want to beat the market or simply track the market. If you want to beat the market, then you can either choose single stocks yourself, or you can pay somebody else to do it for you. Usually that comes with a higher fee, and usually those funds will underperform the index. So be really clear whether what you're buying is an active fund, because that'll completely change the game and usually raise the fee that you pay. Or alternatively, you can just go for a passive fund, which simply tracks the market up or down. And usually that's for a much lower fee. Now, once you've decided which funds you want to buy, you have to own them somewhere, so you have to choose a platform. Personally, I use Trading 212 for my fund portfolio because it gives me access to thousands of exchange-traded funds. This is what it looks like on an iPhone, and you can see that there's a social aspect. You've got communities where you have discussions of stocks, but also exchange-traded funds. There's also the pie aspect, where you can publish your portfolio or look at other people's most popular portfolios. So here you can see the ETF portfolios, which are most popular, or you can create your own portfolio with a pie. So here we're going to search for the assets we put into it. We'll look for a global equity fund. So here we're going to have global bonds as well and gold in the ratio 80-10-10. And then we're going to project its value over time based on our savings. We name the pie and we're off. Viewers of PensionCraft get a special offer from Trading 212 where you can claim a free stock worth up to £100. To get access to that, simply create and verify your Trading 212 account, fund it with a minimum amount of £1, and then you enter the promo code, which is my name, Romin. To enter the promo code, just go to this menu in the bottom right hand of your mobile screen, and then you can enter the promo code RAMIN. Now, the whole reason we invest is to generate return. And beside me here, you can see the return, the total return, once we reinvest income across 3 different asset classes. And I've also shown US inflation. Now, the whole name of the game is to beat inflation long term. And what you can do is use long-term returns to calibrate your expectations about what you're going to get with any investment. So if you buy an equity fund, it would be reasonable to expect a 9% return over the decades ahead. Short term, you'll get big variations around that 9%. Sometimes you get a 50% crash. Sometimes you'll get a 100% return over a short period. But over the long term, equity returns become more predictable. And in terms of inflation busting ability, equity is pretty hard to beat. Bonds, you can see, have underperformed equity long term by a fair old margin. They've returned on average 4.6% since 1871. And then finally, gold has generated 3.1% return. And with any commodity, you kind of expect it to track inflation over the long term. Gold, remember, is a wasting asset. It doesn't generate an income. So whenever you're investing, look at these long-term returns and use them to calibrate your expectations. Another consideration is risk. And somewhat controversially, I'd say that risk is a probability that you won't meet your financial goals. What do I mean by that? Well, it really depends on your investment horizon. How long is your capital going to be tied up in investments before you actually need it? If that period is 5 years or less, well, you probably don't want to take a lot of risk. Equity could quite easily crash over a 5-year period, and when you need your money, you could have much less in terms of capital than you need. So in this kind of short investment horizon, you'd probably want to keep the risk low. And that would mean short duration government bonds, or potentially even cash, or some kind of money market fund. Over that kind of period, equity is probably too risky, so you don't want a big equity allocation. However, if you're investing for 10 years or longer, the picture changes completely. Suddenly what's risky is government bonds. We saw when we looked at those long-term returns that bonds usually underperform equity by over 4% per year. So the probability of meeting your financial goals will actually be lower if you have a lower risk portfolio. That doesn't mean you have to take crazy risk. Global equity is probably good enough. Keep it diversified. But getting that equity exposure will give you the inflation-busting returns that most people need over the long term. Now, when people talk about risk, they usually talk about volatility. Why is that? Well, it's usually easier to calculate than something like probability of a shortfall, which is what we just saw. But what is volatility? Well, it's the typical percentage annual price move in an asset. So, for example, you can see Bitcoin typically moves by around 73% per year. Oil is also very volatile. But then we get to the NASDAQ, which is very tech heavy. That has a volatility of around 23%. Emerging market stocks 21%. Global real estate just under 20%. The S&P would be around 18%. And then we get to a fixed income fund. Now this is very long duration. Remember what we said, that if a fund has very long duration, it's very volatile. And here you can see that in action. Compare that with SHY, which is a short duration 1 to 3 year US Treasury fund, and that has a tiny volatility, not much more than 0. So if you are investing over the short term, volatility is incredibly important. It's something you need to avoid. But primarily you want to choose assets which have a low volatility themselves, and that would be something like the assets in a money market fund. When you add an investment to your portfolio, you'd have to consider whether it diversifies your portfolio. What does that mean in practice? Let's say you've already got a fund in your portfolio, which is the iShares MSCI World Fund. So you can see that beside me here in blue. Now notice that the red line, which is a US S&P 500 tracker, is very closely aligned with that fund. They move up and down very closely together. Why is that? Well, remember that 60% of MSCI World is actually US stocks. So the two are highly correlated. If you've got one, you probably don't want to have the other one as well. So one way to avoid that is to measure the correlation of a fund with the existing funds in your portfolio. And in this case, you can see the correlation is 98%. They're almost identical to one another. Now, long-time viewers of the channel will recognize what's beside me here. I call it a Scooby-Doo tree, but really all it shows you is the correlation relationships between different types of fund. So for example, if we look at the S&P tracker, SPY, you can see it's very close together with QQQ, which is the NASDAQ tracker. Both of them are US stocks, and they have a lot of overlap in terms of their composition. So if you buy one, you may not want to have the other one. Whereas if you buy the S&P and combine that with something like TLT, or a short duration fund like SHY, or GLD, the gold fund, that will diversify your portfolio. That means that the two are unlikely to crash together, and if there is a market event which knocks out equity, your gold fund or your treasury fund hopefully won't move down so much. Now, I wouldn't preclude the possibility that you'd include highly correlated funds in your portfolio. It's just that the threshold has to be higher for them to both make it. You'd have to have very high return expectations for both of them. A very important consideration, because it's one that you can control directly, is the cost of your funds. So beside me here, you can see a snapshot of just over 1,000 UK exchange traded funds. And what I've shown is the distribution of the fees on those funds. In fact, there were some which were even more expensive than I've shown on the graph, all the way up to 3% per year. But most of them you can see are below 1% per year. But nowadays, you'd expect to pay less than the dashed red line, which is about 0.2% per year. In fact, I'd say that's the biggest improvement for investors that we've had over the last 50 years, which is the huge fall in the fees that we have to pay. Another thing which is directly under your control is how often you switch your investments. And the less you do that, the better. There's pretty good research which shows that overtrading usually leads to underperformance. So don't make the brokers rich, make yourself rich. Now, it's possible to have the same fund, but wrapped in a different legal wrapper. Three of the most commonly used legal wrappers are exchange-traded funds. So these are traded on an exchange, just like a stock. They're priced intraday, and you can trade them anytime when markets are open, just like a stock. The value of an ETF is kept very closely in line with the contents of the fund. That's because there's an arbitrage relationship between the fund itself and the contents of the fund through something called the creation-redemption process. Another popular wrapper is an open-ended investment company, as we call them in the UK, or an OIC, or alternatively, what's called in the US a mutual fund. Again, it's a collective investment scheme where people pool their capital. It's invested usually by a manager, and that gives you exposure to the portfolio which is inside the fund. Again, the price of the fund is driven by the value of the investments inside it, but what's different here is that it doesn't trade on an exchange. That means you only get end-of-day pricing. If you want to buy this at 10 o'clock and sell it a minute later, you won't be able to. So these are not traded on an exchange. The third structure which we'll consider is an investment trust. Now, these are usually active funds, they're actively managed, and the value of the investments is driven by two things: the value of the things inside the fund, the assets bought by the manager, but there's also a second factor, which is how popular the fund is. Because as we're about to see, these are closed-ended. There's a fixed pool of capital, and if there's lots of demand for the fund, that can push up its price above the asset value of the stuff in the fund. If it's not popular, it can trade at a discount to the net asset value. So the second dimension we'll consider is the amount of capital in the fund. Notice that the first two wrappers are variable in size. If they're popular and money flows into the fund, the capital in the fund will expand. If people don't like the fund and they pull money out, the capital will shrink. So new units can be created for the top two funds, or destroyed alternatively if money's flowing out. Whereas for an investment trust, the amount of capital is fixed. So if somebody wants to sell their share of the fund, somebody else has to buy it off them. No new units are created or destroyed. And as we'll see, that's important for certain types of illiquid investment. Another reason why the legal wrapper is important is that it affects the fees that you pay, both for the custody of the fund. So on some platforms, you'll pay more for funds, open-ended investment companies, than you would for ETFs, say. There's also a difference in trading costs on some platforms between funds and shares. And remember, shares isn't just stocks, it also includes exchange-traded funds, which trade like stocks, and it includes investment trusts, venture capital trusts. All of those are treated like shares when it comes to fees usually. Now, this isn't true of all platforms. Some platforms charge you the same custody fee regardless of whether it's a share or a fund. And the trading costs can be the same as well. So in other words, you have to research on your platform to see how the wrapper changes your costs. But the key thing is to keep these costs as low as possible, because you can control that directly yourself through the choice of platform, but also through the choice of the funds you have. The final item on our checklist, which we referred to just now, is whether the fund is open-ended or closed-ended. Why does that matter? Well, let's say that we have a liquid wrapper. In other words, it's a fund that can be very rapidly bought or sold, like an exchange-traded fund. You can literally buy and sell from minute to minute. But let's say that the contents of the fund are also liquid. So that might be things like US stocks, which can be bought and sold very easily and cheaply and very quickly. If money flows out of this open-ended fund, it's not a problem because the manager can sell the contents of the fund very rapidly and redeem money to its investors. So this combination of liquid wrapper and liquid assets is absolutely fine. However, we can run into problems if the wrapper is liquid, like an ETF, and open-ended, but the contents are very illiquid. So that would be assets like commercial real estate, which is notoriously difficult to sell in a crisis, or it could be things like unlisted equity, which again is very illiquid. That's because if there are redemptions from the fund manager may not be able to sell the assets quickly enough to give them their money back. As a consequence, the fund manager may gate the fund. In other words, it'll stop you pulling your money out, and usually this will be in a crisis period. So this can lead to a lot of pain. Some people refer to this as a liquidity mismatch. And there are lots of examples of this. For example, in 2022, at the end of the year, what we saw that for some UK property funds, there were these gates that went up because people were trying to get their money out and the asset managers couldn't sell the property quickly enough. So to avoid this, if you have illiquid investments, try to find a wrapper which is closed-ended, like an investment trust. That way, the fund manager doesn't have to sell assets if people want to pull out their money. What actually happens is that the price of the fund falls below its net asset value. So it won't be a gating, it just means that if you do sell, you'll sell at a reduced price. In conclusion, let's quickly run through our 7-item checklist. Number 1, does it give you the exposure that you want? Check the fact sheet to be absolutely sure. Secondly, are your return expectations well calibrated? And here you should use as much history as you can get for your fund or your asset class. Thirdly, do you have control over the risk of your fund? Particularly, will it meet your financial goals over your investment horizon? Fourth, is the fund diversified? And if you're buying a new fund to add to a portfolio, is it correlated with the existing funds? If not, it won't diversify your existing holdings. And it may simply just increase the risk of your portfolio. One factor you can control, which is very easy to control, is the cost of your funds. Try to keep that as low as possible. Always be on the lookout for a fund with similar exposure, but which has a lower fee. What's the legal wrapper of your fund? It may change the trading costs on your platform or even the cost to hold the fund. And then finally, is it open-ended or closed-ended? If the assets are illiquid, maybe you should be going for a closed-ended exposure. That way you won't get gated in a crisis. So those are the criteria I use when I'm buying a fund, and that way I can ensure if I run through the list that I end up with the fund I actually wanted when I click on buy. Now, don't forget our offer from Trading 212. You'll find more about that in the description beneath me, but just use my first name, Romin, as the promo code, RAMIN. And as always, thank you for listening.